It's been about 5 weeks since I've made a video. Sorry for the extended absence, but I found myself lacking anything new to say. Yes, times are changing, and the events are both fascinating and disturbing. However, the timeless principles of wealth do not change. Gold is gold. It does not change. It has seen dynasties arrive and disappear. It has carried wealth through the collapse of nations. It has been well used and misused time and again. It has passed through times when it has been coveted over everything else, just as it has passed through times when most have all but forgotten it. But through it all, it has never failed to preserve the wealth of those who understand it. So what more needs to be said? Well, I recently went back and reread a rather lengthy commentary written in the year 2000 by a man who went by the pseudonym Aristotle. This piece of work was rich in very thought-provoking ideas which helped to shape my own thinking about the proper use of gold in a monetary framework. I decided to read the piece aloud and record it for those in the community who will benefit from it. I'll warn you now, though, you may not find that you like it very much, because the ideas are very different from those who would advocate a return to a fully backed gold standard. But that said, I think most people in this community have very open minds and will find much value to be had. In a nutshell, this piece contains the seeds of an idea which have germinated in the minds of many. I know. I'm among their ranks. Aristotle very eloquently makes the case that the failure of the gold standard was not a failure of gold. The failure was due to an evolution of a system which required gold to be used in a different manner, a manner in which many are using it now. Gold needs to be set free of paper representations of wealth, to be stored physically as the ultimate wealth asset, only to emerge when all other options available under Gresham's law to tender payment are exhausted. If you are curious as to what that means, you will understand by the end of this video. So enjoy what you are about to hear. I'd suggest listening to it multiple times, preferably with enough time in between to sit quietly and reflect on what was said. I'd also encourage you to start some conversations in the comments section of this video to allow your thoughts to commingle with the thoughts of others. Here goes. At first cut, people fall into one of two categories. One, those who recognize the value of an honest monetary system built upon gold, and two, those who have not yet given any serious thought to the matter. Proceeding with the small but special population that belong to the first category, my own experience has revealed them to be inclined towards idealism. Good people, to be sure, and I wish that we were all that way, but while their general awareness of what makes for a more perfect world should be providing them with the fuel for an enjoyable life, instead this level of idealism often blinds many of them to any shades of gray, and there is little comfort living in a strictly black or white world. I write this with hope in the off chance that it may help provide a source of comfort to this small group of idealists, offering them some subtle shades of gray that won't completely undermine their idealistic integrity. While reaching out to my idealistic friends, I also hope to present a roadmap of thought for that larger, all-important population which falls into the second category mentioned above, those that have not yet tapped into a more thoughtful, enjoyable life, which I have seen to be the general hallmark of my few gold-minded friends. Why do I call this second category the all-important population? Because the many do indeed dictate the terms under which the few must live. I must therefore grudgingly devote sufficient attention in this commentary to ensure some of the idealistic readers can see this important shade of gray regarding majority rule. It is my hope that they will then be prepared to pragmatically accept the terms and constraints under which this perfect monetary system must be designed. In this commentary, I shall attempt to clearly lay out what I feel this perfect monetary system to be, the perfect system for a consistently imperfect world, that is. I am not so bold as to think that the world of human ambition and disposition is something that can be altered to suit the perfection of our preferred currency's characteristics, especially the limitations it imposes upon its users, the population at large. I therefore resolve myself, and hope you do also, to the humble thought that our currency system as a whole might be artfully developed into a state of harmony with the world in which we live. The present system, and all failures before it, have been as square pegs in round holes. With the system to be described, I hope to avoid any system that lends itself to the repetition of past abuses and failures. Those familiar with the popular discussions of monetary thought will recognize the common plea to the idealistic gold advocate, calling for the return to a 100% fully backed and convertible gold standard currency system, as if that were somehow the magic pill to cure all that ails us. The solution is not so simple, and to believe so is tragically naive black and white thought. For confirmation of this, look to our past, where you will surely see a familiar world populated with people that were motivated by the same thoughts that motivate us today. In their world, which was fundamentally the same as ours, we have already had a convertible gold standard. But in fact, history reveals that it did not work. Or maybe more correctly stated, modern times reveals that it did not survive. To be sure, any conceivable system might be seen to work well for a limited span of time, and indeed, history paints a vivid landscape populated by many currency creatures of various lifespans. But true success is determined by who remains to answer the daily roll call. However, from where we sit, we can gain important wisdom in the observation that despite the overthrow of the gold standard regime, gold remains an unparalleled reserve asset, carefully weighed, numbered, cataloged, and stacked, resting well guarded within central bank vaults throughout the world, unmatched in financial staying power even as all else fails. Having acknowledged this history, there is no point in rashly calling for us to repeat the mistakes of our past. The problems that killed a fully convertible gold standard back then are still with us today. But take heart, the problem was not with gold itself. The problem was with the gold standard's fit with the prevailing banking and financial system. If we objectively face the cold hard reality, we realize that we can't very well live with the lack of either one. But paradoxically, history shows us that the two cannot sustainably coexist, at least not under the various system designs that were tried in the past. In my usage here, the system refers simply to the dynamic interactions between a currency and its users within the context of evolving economic demands for development, commerce, and banking. Even to the extent of self-destruction, the system is notoriously good at giving the people what they want. It is the subtle changes to the system that I hope to spell out, revealing not how gold can survive society's preference for the current self-serving system, but also how the system can tolerate and survive the discipline of gold. In fact, the diametrically opposed system will not only survive in the face of gold, but will actually be made more functionally viable by gold. Now that you see what we're in for, it seems appropriate to launch my endeavor with this quote from John Kenneth Galbraith. Quote, "Most things in life, automobiles, mistresses, cancer, are important only to those who have them. Money, in contrast, is equally important to those who have it and those who don't. Both, accordingly, have a concern for understanding it. Both should proceed in the full confidence that they can." End quote. It is in this spirit of the assurance that the playing field has been made level for such a little leaguer like myself that I shall embark on the attempt at passing along my own view of the monetary system. We are told above that everyone should share a common concern for understanding it. Actual experience reveals that few people can muster the basic tolerance for any meaningful dialogue on the subject of money. To be sure, they can be seen to talk at great length on the various schemes for making more of it, but not a word is to be had on the design of it. For that reason, I am thankful that USA Gold provides this dedicated roundtable of guests to serve where the general population fails to pursue this line of monetary discussion. Before I go further, I must confess that the map that I see before me for the proper delivery of this presentation reveals a path that I nearly fear to tread. As I've already hinted, it will likely go against the grain of thought among the staunchest of gold advocates, but hopefully my long pro-gold track record will buy me their indulgence as required to read and absorb the thoughts contained in this post, with some remnants of objectivity rather than outright dismissal. Herein lies the thorn. For the reader to have any hope of finding merit in this commentary, he must admit, even if only temporarily, that fiat paper currency, that is, the dollar, euro, peso, yen, etc., is not completely worthless, regardless of the enduring popularity of the notion among goldhearts. Please bear with me. I'm sure you'll like the ending, even if you've already decided that you don't like this ominous beginning. It doesn't matter who I am, but a brief introduction may be called for to help you better understand my position, and thereby evaluate whether or not my own thinking behind this commentary is clouded beyond the best attempt on my part at objectivity. So who is Aristotle? You will know me better from my actions than from any other detail. I seek to recognize both the benefits and the failings of our existing monetary system, and I strive to live life for the full enjoyment and accordance with each. As such, you should be made aware that I already live in tune with what I am about to describe as the perfect financial system within an imperfect world. I fully recognize that I live in a world of fiat currency. Specifically, mine is a fiat dollar world, though not by my individual choice. It's what the majority wanted and dictated, and it's beyond any of us to deny its existence and credibility. Recognize that, and recognize also its failings, and you are poised to enjoy the best life that you can possibly muster. Fail to recognize either side in this day and age, and you are either shorting yourself now by somehow feeling miserable that paper dollars actually work, or you will be shorted later by the inevitable rude discovery that paper dollars weren't quite as good as gold after all. I comfortably walk the line of this understanding that dollars work for a purpose, but are not as good as gold. I live and work in a real world of fiat currency, and there is no point in trying to be circumventive about it. As I work, I am paid by others with fiat currency, and I quite happily pay my own bills with fiat currency. I manage my expenses responsibly, and so there is always some fiat currency left over at the end of each month. This I exchange for gold without fail, to serve as my savings for a later time. No doubt this arrangement will appeal to you in equal measure with your understanding that gold is the ultimate money, with your sense that it won't and can't be manipulated into extinction, and with your appreciation for the notion that a person on average can produce over a lifetime more than he or she consumes. That final element should also hold true for a group of people, such as a nation, and no magic of accounting can alter that long-term necessity. Establishing a reliable accountant for your life's period of productivity should be enough for any honest person, and gold serves that role better than any other. I believe those who share this view are among the fortunate few that are ahead of their time, even as the world is rushing to catch up. This will be clearer in time as I explain. Greed is the one trait that would preclude the successful enjoyment of this present position, a position one step ahead of the following financial evolution. It is a trait that I thankfully find myself lacking, perhaps due to deficiency of imagination. Greed, and arrogance too, I suppose, would entice one to attempt to capitalize on investment leverage and timing of the markets to maximize their gains for the precise day that the world awakens to a new reality. I am far too dull-witted to know the unknowable, so such a strategy of leverage and market timing is prone to unfold as a spectacular failure. And I also find life to be full enough without the added burden of losing sleep at night, worried about such risky investments. Only through the virtue of patience in the understanding that we are for this historically brief time one step ahead of the world will we find in the end that we are among the few who participate in the rewards of a world that suddenly wants to be where we already are. Hopefully, this doesn't strike you as the rantings of an irrational stargazer, so with that view of the author, let's now move on to the heart of the matter. The vagaries of the economic process in the real world make it infeasible to give this matter a comprehensive treatment in this format. So of necessity, I will only build upon the most fundamental core principles throughout this commentary. With the caveat out of the way, let's tackle this fiat currency issue right now so that we may sooner breathe a sigh of relief that the bitter pill has been swallowed and the recovery is at hand. How often have we rallied at one time or another around the Goldheart's battle cries? The Fed, or the banks in general, or government, simply makes this fiat currency from thin air. Fiat money is worthless. Fiat currency is the Fed's or the bank's or the government's tool to keep the poor man down. Well, a cold hard reality is that, contrary to this line of thinking, while I do indeed fit the description, I certainly have not been kept down. Have you? Further, and directly to the point, fiat currency isn't worthless. Have you tried to buy anything with it? Did you succeed? I'm sure that you did. So what does that lesson tell you? As a general rule, a person rarely gets something for nothing. Therefore, the fiat currency must certainly be something, and that something can't be worthless. There is a subtle but important distinction here between being nothing of value versus being no thing of value. A dollar, or any other fiat currency, is certainly no longer a thing, although it once was, back in those days of yore, when it was defined as a certain weight of gold. But it does in fact have value, a value that it finds in the measure of the success with which it retains the original concept of value that it represented at the time of its origin, at loan creation. This concept is built on a unit foundation of arbitrary size, to be sure, and there can be no doubt that this remains a fundamental weakness for it to serve properly as money, which is as a medium of exchange, a store of value, and a unit of account. Nonetheless, the value in any given currency unit originates in the terms of the loan contract in which the borrower has promised to repay those units of currency to the lender. And while it seems that those currency units are indiscriminately created out of thin air, each of the many trillions in existence today were created through the joint cooperation of a lender and a borrower. It takes two to tango. Want to find value in the dollar? Simply track down a new homeowner who toils each workday to pay off his mortgage. Is he evil for borrowing money from thin air? More on this later. It's easy to convince yourself that people will provide goods or services in return for dollars, either because they themselves are in debt, or they are in need of currency to repay their outstanding debts, or else because they believe with near certainty that these same dollars will be useful to them as a medium of exchange when they encounter somebody else who is burdened with outstanding debts. But there is a commonly stated problem with fiat currency. All in all, the system works about as well as any other man-made thing. Unfortunately, taken as a whole, dollars retain their original value only as reliably as wage earners and price setters remain content with past pricing levels. And that is influenced in large part by the perceived ease with which additional dollars may be obtained or loans defaulted on. If a significant number of borrowers will not validate the dollars that they borrowed through some manner of equivalent production, then the foundation of its value is eroded. Our own federal government, for example, in its consistent failure to balance its operating budget, has effectively become a significant collective of borrowers that refuse to service their debt because they don't pay back their loans. The government is thereby failing to validate its many trillions of borrowed dollars, and the currency system suffers. The dollar value falls, and prices generally rise. The flip side of the coin regarding the monetary system is where loans are being paid back more rapidly than new loans are being written to keep outstanding money supply expanding with the prevailing growth rate of the real economy. In this circumstance, increased competition for dollars during this relative contraction in the money supply generally results in an increase in the dollar's value, and prices generally fall. The problem with these expansions and contractions, these inflations and deflations of the currency supply, is that in business and private life both, people tend to enter into long-term contracts. Because earning power, prices, and wages are subject to this variability over time due to changes based upon the business cycles and monetary supply, the act of entering into long-term contracts becomes a mixture of faith and gambling. As I've stated in an earlier post, people have generally been more comfortable to see monetary supply inflation erode the purchasing power over time. The coping mechanism is to renegotiate for pay raises and to face paying higher prices. They are less willing and less happy to renegotiate for lower rents and wages and lower prices received for goods resulting from currency that gains in value over time. Due to the prevailing inability of people and businesses to accommodate a currency that gains purchasing power over time, the fallout is harsh. Instead of adjusting the price of contracts downwards, the reaction is typically to reduce production and cut back on labor when business profits yield fewer currency units. Economic recessions and depressions are frequently the undesired effect of currency supply that either fails to grow as fast as the economic demands, or worse, a currency supply that actually contracts. This has traditionally been the impetus for a well-intentioned government to attempt various degrees of monetary interventions to bring about more desired economic conditions. No doubt you are familiar with these problems, and tend to agree with our intrepid forefathers whose anti-banking, anti-fiat currency pronouncements are legendary. In all frankness, these were a handful of exceptional men living at an exceptional time and who accomplished an exceptional feat, the birth of a new republic. It should not therefore come as a surprise to anyone that the opinions and desires so expressed by the likes of Thomas Jefferson and John Adams raised the bar for performance so high that practical performance by the multitudes of mortal descendants could not do but fall woefully short of their lofty vision. In light of their exceptional life and times, they desired perfection. And why not? They thought that they had set the world itself into a state of perfection. I am not saying that perfection is not a worthwhile goal, but I am saying that we must at least be rational about what we can and cannot achieve in a real world populated by, well, just look around you. Please forgive me my haste when I don't look up the exact quote here, but I seem to recall the great Thomas Jefferson once voiced his conviction, which after all those years still has appeal and finds ample support among gold advocates. Quote, "If banks are allowed to control the money supply first through inflation then deflation, our children will wake up homeless on the continent that their fathers conquered." End quote. The implication is that banks will use their credit from thin air in return for the pledge of collateral against the return of that credit, drawing in everybody such that the currency value falls, prices rise, and people seek ever more loans in their desire to buy before prices rise further, with the added benefit of paying off the loan with devalued currency. But then, in their nefarious desire to rule the world, the bankers would cause the money supply to deflate, making it difficult for everyone to successfully obtain the cash needed to repay their loans. The bankers then walk away with the collateral, leaving the borrower with nothing but bad credit to show for the experience. On the face of it, this seems to be a noble enough assessment, and gives rise to the equally noble suggestion that our problems would be solved if banks could simply be done away with. These institutions that were once said to be, quote, more dangerous than standing armies, end quote. So there you have the perfect inspiration for the monetary system of your dreams, worthy of any true patriot. You suggest that we eliminate the banks, and with them goes the inflation threat from the paper money that they create, leaving us only with gold coins as currency. Okay, for the sake of indulging this off-the-cuff perfect solution, let's be optimistic and assume that we could indeed suddenly find ourselves in a system in which banks are non-existent and only physical gold coin is currency. In our euphoric pursuit of perfection, we need only roll the clock forward from this perfect starting point to see that we've rashly and incorrectly assumed that our modern problems could be avoided. First come the banks out of necessity, and then the fractional reserve lending phenomena naturally evolves into existence, whether or not it was deliberately intended from the outset. Are you skeptical? Consider this. It would be a mistake to give thought to monetary matters without due consideration of the weave of our social fabric, examined through the magnifying lens of history. In the real world, banks are necessary. We need only look at the circumstances surrounding the appearance of the first significant public bank as documented nearly 2 centuries after the fact by Adam Smith in his Wealth of Nations. Written as America was just a newborn pup. The setting was Amsterdam, a bustling international trading center as the 1500s gave way to the next century. As Adam Smith describes it, the bank was formed and thrived by filling a public market niche, addressing the corruption of the currency. In settlement of trade, gold and silver coins from the many countries of many mints, public, private, and some disreputable, were in circulation, and as is ever the case, the coins of inferior alloy or those that were clipped of proper weight were always the first to be offered to the merchants. In addition to the money-changing manuals that served to document the money content of the coins from the various known mints, the merchants had scales to verify the sum of the coins offered as payment. However, the good quality and reputation of these scales was seen as suspect in the eyes of the shopper, even as the coins were seen in the eyes of the merchants. Smith wrote, quote, "In order to remedy inconveniences, a bank was established in 1609 under the guarantee of the city. This bank received both foreign coin and the light worn and other debased coin of the country as its real intrinsic value in the good standard money of the country, deducting only so much as was necessary for defraying the expense of the coinage, and other necessary expense for management. For the value which remained after this small deduction was made, it gave a credit on its books." End quote. And here you see the coins naturally coming out of circulation in favor of a mathematically certain bank account. In this way, much of the effort and cunning that went into adulterating the coinage by men of low integrity was thereby rendered unprofitable. This system worked well for all the parties involved in trade, and the popularity gave rise to similar banks in the nearby trading centers of Delft, Middelburg, and Rotterdam, and those other countries. History has records that banks have also come into being for the purpose of the security against theft. Early metalsmiths also became early bankers by virtue of the security offered by their strongboxes. What practical-minded person would deny the modern need for similar service in the event of a return to a strictly gold-based currency system, for safekeeping and for quality assurance? The Bank of Amsterdam was said to work well for a full century, with a man's deposits remaining on actual deposit until the time at which he transferred the money in payment to another man's account. The money, gold, was not lent out, and so when Louis XIV's French army approached Amsterdam in 1672, causing the depositors to rush to the bank in fear for the safety of their money, those panicky depositors all discovered that their money was indeed on hand for immediate withdrawal. The fear-induced bank run gave evidence of yet another universal truth about the nature of mankind, that when satisfied as to the apparent safety and availability of their deposits, they no longer desire to follow through with the actual withdrawal of their funds, remaining content to let the bank serve as guardian. And so we have the seeds of the eventual fall of the Bank of Amsterdam and many thousands of its successors. The bank's ownership by the city of Amsterdam gave rise to the close associations with the Dutch East India Company by virtue of the same men often involved in the governing or management of both operations. Due to the nature of their business, when literally waiting for their ship to come in, even while still a solid company with solid profits, the East India Company would from time to time need a short-term provision of credit. In a precursor of what modern banks would come to call their bread-and-butter business, the bank began to provide these loans to the company out of depositor accounts. When business profits turned south for the East India Company in the late 1700s, as many ships and cargo were lost in the war, the loans increased. The city government itself also came to rely on the bank for loans. During the first century of operation, merchants preferred to receive payment in bank deposits instead of the uncertain quality of the coin of the day. But as the loans of the bank increased, and as the bank began to put limits on withdrawals or transfers to accounts at other banks, merchants began to cast a wary eye on the payments made in bank deposits, and they raised their prices to reflect this growing uncertainty, discounting the value of the bank money. And as you might expect, when a bank can't be counted on to reliably provide you your money on demand, its days are numbered. And so it was for the Bank of Amsterdam. The doors were closed in 1819. It should also come as no surprise that a similar scene was played out many times on a smaller scale by the metalsmiths, as mentioned earlier. Many being sought out for the security of their strongboxes, and after a period of reliable service, many smiths would observe the willingness of their depositors and the citizens in general to leave gold under lock and key, opting to circulate the receipts of ownership instead. The more unscrupulous among them would come to grant loans to others for profit, or else grant loans to themselves through the issue of receipts for more gold than they had. When rumor brought about sufficient alarm to bring in an abundance of receipts for redemption all at once, the game was up and justice came swiftly. Though to be sure, the righting of the wrong on the inevitable day of reckoning was completely unsatisfactory to the good citizens left holding worthless gold receipts from the bank after the gold ran out. You have likely identified the problem in both of these examples. The entity providing the banking service began issuing loans using customers' deposits without the consent and cooperation of the depositor. Let's consider an example in which the bank is of the most noble character in management, simply offering safe storage and quality assurance for the gold currency. It is human nature that those with wealth, such as we might find among those having deposits at the hypothetical noble bank, might come to generate some income with their wealth. They might play an active role in this attempt as a venture capitalist, offering their money directly to the entrepreneurs in return for some profits after personal negotiations convince them of the viability of this prospect. But not all would-be lenders and borrowers are well suited to negotiate and organize such arrangements themselves, particularly the smaller would-be lenders seeking an income and the smaller would-be borrowers seeking funds for such things as small business expenses. The noble bank easily develops the in-house expertise in evaluating those borrowers that represent a good credit risk and can organize the formal loan arrangements on behalf of their depositors. And rather than matching up a depositor and a lender with a borrower on a personal individual basis, the noble bank would come to pool the depositor's funds into an anonymous operation in which the profits from the lending of the capital are then provided to the depositors according to the amount of funds the depositor put into account with the bank. This provides the flexibility demanded by the banking depositor to generally be able to access his funds as needed. It's like this. Assume that you, me, and someone else each have put $10 in gold coin on deposit with the noble bank for safekeeping, with the added hope to earn a return on the bank's ability to lend it for a profit in the meanwhile. Let's say that a shoe cobbler needs to buy leather and a new sewing machine in order to make new shoes, so the bank lends him $18 of the $30 available. The cobbler takes this borrowed gold, makes his purchases, and sets to work in order to repay the bank $19 from his anticipated profits within the coming months. In the meantime, you incur unanticipated expenses and need to obtain your $10 deposit back from the bank. Now, because the bank wants to keep you happy and to retain your future business, it doesn't tell you that $6 of your account is currently unavailable, out on loan, as per your wishes for the bank to earn you an income, and that the cobbler will be returning it along with the profit that you sought in regular installments over a period of time. Instead, the noble bank gives you $10 of its remaining $12 and hopes that neither me or the third depositor will want to reclaim our own deposits anytime soon. Here you can see that no money was created out of thin air, but the size of the noble bank grows as a good track record of management attracts ever more deposits in which withdrawals don't threaten the remaining funds on reserve, and the depositors all come to perceive that through their good experience that the entirety of their account is available to them should they need it. The bank would accommodate this concept of reality by shuffling the credit distribution among the accounts to provide the depositors money on demand. This creates the illusion of money being in more than one pocket at the same time, though through no fault or evil intent on the noble bank. This is what the users of the system wanted, and this is what we got. And as the cobbler's leather supplier deposits the cobbler's gold payment into the neighboring honest bank in order to earn a return, the process may continue yet further. The economy seems to experience an abundant money supply, and the purchasing power of all the funds are thereby diminished by rising prices as the actual goods offered for the sale are then held more dearly than the money which has suddenly become so easy to come by. Please note that in this example, I didn't once use the term interest in connection with the lending of money. A great many of the overzealous gold advocates try to equate the lending of money at interest with the evils of usury, so I purposely avoided that trap, which has become a mental stumbling block in their thinking. While they might be inclined to say rightfully or wrongly that lending at interest should be banned in order to eliminate the sin of usury, they certainly can't make the claim against the form of venture capitalism that I laid out above. And if the banks come to define the terms of providing venture capital from their available pool of deposits as a standard low interest rate rather than higher claims on profits that vary from borrower to borrower, what's the harm? A quick historical note is in order here on the position of famed economist David Ricardo, who was a strong supporter of the Bullion Committee and its position in favor of the gold standard in monetary discussions hosted by the Bank of England in the early 1800s. The purpose of the discussions was to get at the root of the problem regarding rising prices, including the price of uncoined gold bullion. The center of the debate was whether the banknotes, which by that time had formed the bulk of circulating money supply, were losing value, or was it gold that was simply rising in price? Given the observation that other prices, such as bread, were rising, the verdict was against the banknotes, just as it was in the latter years of the Bank of Amsterdam, when the merchants had diminished faith that the bank could successfully redeem its credits for gold coins. In the course of the debates, Ricardo described in his words, quote, "It was most justly contended that a currency, to be perfect, should be absolutely invariable in value," unquote. While conceding that precious metals couldn't be held to the desired level of perfect invariability, they remain the best suited item that we have discovered, and yet, while holding this position, Ricardo was not completely opposed to banknotes, finding them to be economical and convenient, so long as they were always fully exchangeable for metal upon demand. I'll say again, if the noble bank could legitimately tell a rational depositor that a portion of his deposit wasn't immediately available for withdrawal, then things would likely be closer to okay, with the banknotes in circulation representing the gold allocated to the borrower and properly held aside for redemption of the note as Ricardo would have it. While this sounds good initially, there would still be some perception of an abundant gold supply due to the borrowed funds hitting the marketplace, and there would still tend to be the resulting diminution of the currency's purchasing power. And further, the banks would always try to accommodate the depositor's desire to withdraw funds by reallocating their available resources, leading to a false, and eventually fatal sense of security in the general nature and supply of money. As you can see from everything above, it begins innocently enough. The depositor's money is physically distributed, unlike the ledger creation of credit money used today, but it would not be long before the depositors, who had thus risked their deposits for a return, came to have faith that their full deposit would be returned with interest, and acted on faith as though the gold was actually still at their immediate disposal. But inevitably, the day always comes when confidence is in short supply and depositors rush en masse to reclaim their deposits, feeling that money in hand is more desired than the prospects of any returns that the bank may have to offer, or perhaps fearing for the viability of the bank itself and its ability to provide gold for the quantity of funds in the account. And as it begins innocently enough, it ends innocently enough too. The availability for the common man to get a loan serves as an undeniably equalizing force in society. It allows a poor person with time and energy to participate in the economy on par with the man who has his own capital. Through the credit obtained from the bank's pool of deposits, a borrower is able to gain possession of land, building, tools, raw materials, or other goods and facilities with which to become a farmer, a manufacturer, or a merchant, using the profits from his time, energy, and know-how to earn a living for himself and to compensate his lenders for their extension of credit. The poorer and more wretched a man might be, the more he might wish for the presence of a bank of low standards willing to extend credit to the likes of him. But despite this common desire for banks, even from the very beginning, there has always been an element of society that for one reason or another saw banks as fraudulent means of transferring the wealth of honest workers to an elite group with agendas to rule the world. In a letter to John Adams about his own fear and loathing over the proliferation of banks and their issuance of paper credit, Thomas Jefferson wrote in 1814, quote, "I have ever been the enemy of banks, not of those discounting for cash, but of those foisting their own paper into circulation, and thus banishing our cash. These are to ruin both public and individuals. This cannot be done. The mania of borrowing and lending is too strong. It has seized by its delusions and corruptions all of the members of our governments, general, special, and individual." End quote. But in contrast to Jefferson, in a little publicized footnote of history, Benjamin Franklin was a strong supporter of paper money. He saw that a national paper money provided a general benefit of facilitating alternatives for a government against the dual horrors of its citizenry of taxation and deflation. And as mentioned in the preceding paragraph, very specific benefits were seen on an individual basis by those who sought loans of any form of bank money, gold, paper, credit, whatever, in order to improve their position in life. Because the little guy clamors for loans just as the big guy who pursues bigger projects, and because the banks, which were naturally established to help the marketplace maintain the safety and quality of its original gold currency, come to naturally play the middlemen between the population with money to lend to the population seeking to borrow, the blame for all that follows is hard to pin on anyone specifically. Almost everyone in modern society comes to rely on the continuing and smooth operation of the banking system. As outlined throughout this commentary, you can see that it is civilization, and as it advances, and as the economy expands and the population grows, the general trend is for the apparent money supply to expand, even if banks themselves do nothing more than efficiently reallocate deposits as needed to keep everybody happy. The threat of a bank run grows with the growing disconnect between what is perceived as the fair value contained in the underlying gold contained in the coin that originally defined the currency unit versus the witnessed purchasing power of the same currency units as dictated by the apparent swollen supply as borrowed and efficiently allocated by banks. Due to the unacceptably disruptive nature of bank runs on society, and the hurt inflicted on those who were late to the doors and therefore left holding worthless receipts of a newly failed bank, the inevitable outcome, generally tolerated by most, is twofold. First, for the officially sanctioned government regulation of the development of a national central bank to bring more order to the hodgepodge of wayward private banks, and second, for the eventual officially sanctioned termination of gold convertibility for the abundance of circulating banknotes and bank deposits on account. So who's to blame when the system fails? Perhaps it would be clearer if I rephrased that question. The system, as I've defined it, is the ever-changing monetary principles, policies, and practices seen in the course of satisfying the real demands of conducting business and commerce among real people. At any given moment, the system is undergoing change from one form to another, generally smooth and gradual, but occasionally abrupt and painful. But never in the largest sense can the system itself be said to fail, although parts of it certainly prove troublesome and are altered from time to time as economic efficiency dictates. Did the old gold standard era system fail when there was a bank run at one institution or another? Well, if you were a depositor who didn't get your deposits out before that particular bank closed its doors, you might indeed be inclined to say that the system failed. But more specifically, it failed you. Meanwhile, your contemporaries who lived half a continent away might say that the bank closure was a healthy adjustment to the system, weeding out a weak bank. As such, system failure might be viewed as any time you were legitimately dissatisfied with its performance. Therefore, it would probably be more appropriate to ask this question instead. Who is to blame when the system disappoints you? An important thought to consider in this regard is whether any conceivable system could please all of the people all of the time. Let's briefly examine the dissatisfaction of the typical Goldheart. In his mind, the system has failed because he is dissatisfied all of the time, so long as gold is not the circulating currency, apparently. How irrational is that? Romantic, to be sure, but completely irrational. This superficial desire will never be the impetus for a change to the system as we know it. Even in the good old days, the coins quickly gave way to banknotes as the circulating equivalent. There simply must be more at stake than the whimsical preferences of an individual in order to inspire change. Here's the key factor, as detailed earlier in this commentary, which ultimately argues forcefully for the proper role of gold in the monetary system's architecture. In what has been revealed as a misplaced goal, with gold as the circulating currency, artificial inflation of the gold supply is the unavoidable consequence, because money will always be lent by somebody to somebody else who wants to borrow. As a result, under any past system architecture, there has never been a truly satisfactory means of safely and reliably escaping the ravages of inflation and deflation. Having gold attached either directly or indirectly to the circulating currency, or gold itself subject to being lent independently as we see today, the proper valuation of gold is always understated by the market due to the perception of an increased artificial supply. Truth be told, it is this element that gives rise to my own dissatisfaction, that gold is not at all points in time held near to its honest, physical-based monetary valuation as it should be. This is true at nearly all points in time except for those brief and historic moments when the adjustment inevitably comes and gold reaches an entirely new price plateau. This proves unacceptable for those who live in the interim periods as they strive to protect their personal wealth. Those holding gold during the last 20 years, for example. Although, make no mistake, the extent of the currency depreciation in various non-OECD nations would paint a more normal-looking picture for citizens holding gold within those countries. As the number of people increases who are dissatisfied with the system's performance at any given moment in time, the greater the pressure mounts to effect some degree of change. Similarly, the greater the level of dissatisfaction, the greater the impetus to effect some rectifying change. For those who are yet clinging to the notion that we need a gold standard with fixed convertibility of the currency, please forgive me as I verbally try once again to shake you out of your mental stupor. Under a gold currency-based system, anytime someone borrowed money, they would in essence be participating in a gold loan, much as we see happening today, an act that is ill-tolerated by those who can rightly recognize this depressing effect on the value of that same gold money. For the 100th time, because people will always have a desire to borrow money to meet their business or personal needs at one point or another, you would always be dissatisfied by any gold standard that allowed these gold loans to occur. Meanwhile, everyone else would be dissatisfied by such a gold standard system that specifically pleased you, in which money, which would be gold, could not be borrowed as needed. Any properly functioning monetary system in the real world must accommodate those seeking to borrow funds. And if I've made no other point but one, we should all see from the extensive commentary presented earlier that such a system cannot sustainably coexist with a gold standard which has a fixed convertibility. Inflation is always a consequence, and then so are bank runs, a phenomena unique to any such standard of fixed convertibility. There can be little denying that those bank runs are the ultimate monetary catastrophe experienced on an individual basis. Think about it. If you were among the depositors left with an unhonored deposit of metal on account at a failed bank, you might as well be located in a modern-day third world nation when its currency loses complete value. Your life savings have been wiped out through no fault of your own. Examining this case of a bank run, everything was working fine for you and your currency units yesterday, but then suddenly your world fell apart today. In truth, to witness that a bank run was justified by the bank's obvious after-the-fact shortfall of gold necessary to honor all of the deposits reveals with abundant clarity that a goodly portion of the system's funds were actually unbacked currency. And since these same unbacked currencies were seen to be functioning well prior to the pain of the bank run, it makes little sense to those left holding the bag in a bank run. And as hard as it is for these unfortunate citizens to fathom fundamentally why these currencies could work yesterday, but not today, it is even harder for them to grasp why the same currency could function properly at the front of the bank line, but not for those at the end of the bank line. It is this kind of pain, especially when the bank runs become an epidemic, that compels significant changes to be made to the system architecture. History reveals that a natural starting point to ease the pain is national regulation of the scattered and various independent private banks. This leads to a united we stand, divided we fall solution in which resources are managed among the banks so that the individual hemorrhages can be addressed without leading to domino-style bank failures. But ultimately, the whole system is put at unacceptable risk from bank runs inspired by the realization that the bank money inflation has rendered a currency value that is less than the metal value in the system's few coins. Again, the institutional thinking goes, since all of this unbacked paper worked yesterday, let's just get rid of the inspiration for bank runs, the gold coins. Those finding themselves in the back of the lines certainly would welcome this. Their currency would not only remain just as good as the currency held by those in the front of the line, but it would also not be significantly different than it was yesterday. Okay, so who is to be blamed for our disappointment with the system as it is? The lesson to be learned is not to blame the push for fiat currency upon us by the few and the powerful men of wealth of the world. While inflation can be bad, even under a gold standard, along with the pain of bank runs for those who fail to rescue their deposits, inflation has the distinct opportunity and track record to be much worse within a system built upon a fiat currency. The truth is, inflation hurts those with money, it erodes their purchasing power, and helps those with debts. It makes loan repayment easier. David Ricardo said it eloquently, quote, "The depreciation of the circulating medium has been more injurious to moneyed men. It may be laid down as a principle of universal application that every man is injured or benefited by the variation of the value of the circulating medium in proportion as his property consists of money, or as the fixed demands on him in money exceed those fixed demands which he may have on others." End quote. He said further that the farmer, quote, "more than any other class of the community is benefited by the depreciation of money and injured because of the increase of its value." End quote. This is likely for the dual reason that the farmers as a general rule were often in debt to begin with, and because of their annual creation of crops, from thin air I might add, could then be sold for more currency units in each subsequent year, even if the net real-world value of the product being offered remained entirely unchanged. And so we can see, with more people in society having common wealth than uncommon fortune, it is distinctly the case that democracy proves to be the greater threat to a convertible gold standard than does even the unmanageable expense of war. I faintly recalled some historical figure who made the astute observation that in a democratic society, when the people come to realize that they can vote largesse for themselves from the public treasury, they will do so, and hence bring about their system's collapse. And in researching this matter further, it seems that there actually have been a number of figures echoing the same sentiment through time. But regardless of the precise citation of the quotation, one look at the growing national debt of America, serving as the substitute for the taxes that would otherwise be necessary to fund our chosen social programs, gives credence to this assertion. Simply put, the people, or the masses, get what the people want, and the people apparently want easy money. Even outside of a democracy, over time, the forces of the population always win out over the forces of the few men of power. And in the end, it matters not which group is on the side of good and which is destructive. The many prevail over the few. So what is the proper role of gold in the monetary system architecture? At this point, the staunchest gold supporters are likely gnashing their teeth and forming a posse to hunt me down for a proper lynching, I'm sure. After all, I have made no bones about the need to cut gold out of any ties whatsoever with the various national currencies. Due to inflation and deflation that naturally arise through variations in the rates of borrowing, payback, and growth of the economy, currency fluctuations lead to bank runs, which are frankly too disruptive and are not to be tolerated. Fortunately, they are rendered completely meaningless under a fiat currency regime. National fiat currencies allow governments to manage their own national economies to the extent that they are able, and to take whatever efforts needed to avoid falling into those most destructive currency deflations that wreak havoc on economies. Gold must be removed from these currencies so that governments are not tempted to manipulate its perceived value in order to give a boost to their own currency. The goal would be that a sudden value shocks will still be avoided, because at all points in time the currencies will be fairly valued against gold. There won't be an inevitable and recurring day of reckoning, in which the pent-up false perceptions are unwound amid calamity and crisis of confidence. Gold must also be removed from any element of the monetary system that would seek to make loans using gold, because, as we've seen, these confound gold's ability to reach its true physical-based fair market value. Gold derivatives must also be done away with for the same reason. Gold must remain a pure monetary asset, bought and sold and owned outright. Nothing else would be allowable. National fiat currencies will ably service the market's various needs to borrow funds. After all, that's how fiat currency is born in the first place. And although I've seemingly cut gold out of the monetary system, that is really not the case at all. Gold qualifies as the only true money, being able to function as a unit of account, as a medium of exchange, and as a store of value. A fiat currency only meets the first two elements, but they fail as stores of value. Therefore, gold will be the money of savings, while national currencies will be the currency of commerce. They will all float relative to each other and constantly seek out their proper value. Kept with special status as an independent and unlendable currency, gold will be the ever-rising North Star of the monetary system. Central banks would be inclined to hold gold, and only gold, in reserves of any significant size, because gold is not the liability of any other nation, and its real-world value would continue to grow over time. As said before, quantities held in other national currencies would be done only to the extent that they facilitate trade between active partners. Individuals across the earth would also choose to hold gold as their savings, their life's productivity forever protected from inflation and deflation, and from the reliance upon another person or nation's liability. The beauty of reserving gold as an unmanipulated monetary asset is that individual local currencies can still be managed by their governments in whatever manner is seen befitting the specific country, without having an adverse effect on the meaningful wealth held in reserves in the form of gold savings among other nations and local citizens alike. No single national currency need ever be held by another nation as a reserve currency, which unfairly allows the nation that issues the reserve currency to export its inflation. However, a nation might choose to hold another's currency in a quantity simply because it makes for expedient trade. And this brings us to the reassurance of Gresham's law. Perhaps a short lesson is in order for those new to this realm of thought. In 1558, Sir Thomas Gresham made his observation that whenever there was a latitude in the tendering of payment, as could be seen in the major medieval cities where the coins from many lands came together in the course of trade, as we covered in the case of Amsterdam, inevitably the money of poorest quality was offered while the better money was retained. In describing the circulation of currency, Gresham's law says that bad money drives out good. The inferior money circulates, while money of superior quality is held. In our new system, herein described, paper currency will circulate while gold money will be saved. Pause for a moment to fully consider this practical notion of saving gold on one hand, while on the other, borrowing and spending paper just as we always have in our lifetimes, and know of no other reality from personal experience. This is in perfect tune with Gresham's law. Given our own limited history, this accord with Gresham's law provides a very comforting reassurance for predicting the success of the system. Why? Because Gresham's law is arguably the only economic law that survives beyond challenge, an echo of the universal and enduring truth that given a choice, people will choose the option that serves their own need best. Gresham's law predicts that the world's supreme currency, gold, would not actually circulate in a conventional sense, though it would move from hand to hand, from one saver to another individual, as circumstances might require. Sure, you could use it outright as money if you insisted, but nodding to Gresham's law, wouldn't you rather keep your gold for the rainy day and spend your paper instead? This system will enhance the transparency of national economies and financial positions, rewarding those with good fiscal policy and balanced budgets, and giving none an exorbitant privilege over another through reserve currency status. It will allow the citizens a natural avenue to protect themselves against depreciation of the national currencies, which will inevitably inflate until the end of time, and also to actually gain a no-risk real return by simply holding the metal without the self-defeating aspect of lending it out for interest. Gold. Get you some.